Hello and welcome. I'm Blair Blackwell, and this is the Daily Market Brief. Let's catch up on what's moving in markets today. Good morning and Happy New Year. It's Wednesday, January 1st, London Open Prep, and this morning, three themes stand out. A quiet, holiday-thin start with a lively debate over how fast U.S. rates might fall. Energy still driven by fundamentals, despite geopolitical noise, and Europe signaling more strategic self-reliance as 2026 begins. On the macro side, the Federal Reserve's December minutes show that last month's rate cut was a close call, underscoring a cautious committee. Yet the data backdrop isn't soft. Weekly jobless claims fell well below expectations, a reminder that layoffs remain low, and some see that as trimming the odds of aggressive easing, while others, like economist Mark Zandi, still expect 3 cuts in the first half of the year. In housing, the outlook points to elevated mortgage rates and prices, but slower gains and a bit more supply that could give buyers more negotiating room. Europe opens the year with a message of autonomy. EU leaders insist the bloc is not at the mercy of great powers, even as Spain prepares for the final phase of a sweeping judicial overhaul, and Brussels debates how to strengthen its financial system to channel savings and support innovation at scale. Meanwhile, the FTSE 100 just closed its best year since 2009, and there's a small dose of good news from China, where factory activity edged back into expansion after months of contraction. Energy and geopolitics are in focus, but price action remains grounded in fundamentals. Russia's oil and gas revenues are under strain as exports plunge, and pipeline gas to Europe sits at all-time lows, chipping away at a key pillar of the Kremlin's budget. Iran faces fresh protests, a weakening currency, and the overhang of potential strikes, adding a layer of regional risk. And Europe voiced concern over Chinese blockade drills around Taiwan, even as Washington played down the novelty of the exercises. Stepping back, a look at 2025 shows oil prices fell despite persistent tensions. Electricity demand outpaced grid readiness, and old technologies proved more durable than many expected. In the battery supply chain, graphite names have caught a bid amid China tensions and electric vehicle enthusiasm, while precious metals slipped after another hike in trading margins capped a blockbuster year. Turning to markets, holiday conditions keep moves modest. The dollar's broader gauge has eased in quiet trade. The euro has nudged off recent lows, and dollar-yen ticked up on the firmer U.S. claims print. In commodities, oil is balancing geopolitical headlines with the reminder that supply, demand, and infrastructure are calling the tune. Gold and silver are softer after higher margin requirements, a technical headwind into the new year. Looking ahead, it's a quiet calendar today. The focus turns to early January data and policy speeches later this week for confirmation on growth, inflation, and the path of rates. What I'll be watching today? I'll be watching dollar-yen for a gentle uptrend if U.S. labor resilience keeps near-term rate cut bets in check. I'll be watching euro-dollar for a steady to firmer tone on the mix of European policy steadiness and that tentative China PMI improvement. In commodities, Brent crude in a range, with Iran risks versus the broader fundamentals first narrative, and gold with a slight downside bias near term after those margin hikes. For beta, the Aussie against the US dollar could find support if battery materials optimism and China's manufacturing pulse persist. The takeaway: optimism is building into the new year, but for now, fundamentals are still anchoring markets more than the headlines. That's it for today's edition of the Daily Market Brief. Thanks for listening. I'm Blair Blackwell. This podcast is for informational purposes only and does not constitute financial advice, trading recommendations, or investment guidance.